Hi everybody, in this example we are going to calculate something called operating leverage. What we are going to do is show the mechanics of actually calculating the operating leverage and then try to understand what it exactly means. In the problem we are given that the sales price unit is 3,000, we are selling 5,000 units, total variable cost per unit is 2,500, and my total fixed cost is $1.5 million. Given these, let's first of all calculate the operating income. My revenue is nothing but the price multiplied by quantity. 3,000 multiplied by 5,000 is $15 million. My total variable cost is nothing but the quantity multiplied by total per unit variable cost total. It turns out to be 12.5 million. Contribution margin, remember it's from variable costing, it's revenue minus all variable cost, is 2.5 million. My total fixed cost is 1.5 million. Contribution margin fixed minus fixed cost is going to give me operating income. Now, operating leverage is nothing but the contribution margin, this guy, divided by operating income, 1 million. 2.5 million divided by 1 million is 2.5. But what does that exactly mean? What is 2.5? What that means is for every 10% increase of sales, the operating income will increase by 10% multiplied by 2.5. So it will increase by 25%. If my revenues increase by 10%, my operating income is going to increase by 25%. Similarly, if it decreases by 10%, it will decrease by 25% as well. So it kind of measures, the operating income kind of measures the sensitivity of your operating income to sales, to revenue. So the higher the number, the more sensitive it is, so you have to be very careful about that. Usually it's preferred that the operating leverage is a lower number. In this case we have 2.5, and let's actually look at how 10% sales increase is actually converting into an operating income of 25%, which is 10% times 2.5. If I increase my revenue by 10%, what's going to happen is my new revenue is going to be 16.5 million. My variable cost will increase as well, exactly by 5%. My contribution margin is going to increase exactly by 10%, from 2.5 million to 2.75 million. My fixed cost will stay the same, and my operating income will increase from 1 million to 1.25 million. This increase is 25% increase. And look at here, the revenue was increased by 10%. It exactly predicts what happens when you increase sales by 10%. Multiply that by the factor of operating income or operating leverage. You are going to get 25% increase in operating income. And again, it is the sensitivity. It doesn't always increase. If sales decrease by 10%, your operating income will decrease by 25% too. Hence, what operating leverage is the sensitivity of your operating income over sales. And the way it's calculated is by dividing contribution margin to operating income. And it's trying to find out the kind of the role of your fixed cost between the contribution margin and operating income.